I wonder if there's an impact that you've seen of coronavirus on the process of companies coming public because of that narrative that this pandemic has accelerated the future, because of all the investor attention on the stock market, retail investor attention. If you're looking for growth, if you're looking for a return, you can't go to bonds. Has all of that, in a way, perhaps intensified the valuations?
I mean, possibly. There's one thing we know for sure, which is one of the many I would call false rules about an IPO process was that you had to go meet people in person. And this was one of the reasons people would argue that direct listing wouldn't work. And that's been blown out of the water, right? Because even the traditional IPOs now are using video conferencing and Zoom for those types of things. There is certainly what I would call a highly speculative nature to the markets today, a willingness to take on risk, a willingness to get excited about projects that may be 5 or 10 years into the future that we haven't seen since the '99 timeframe. I really can't speculate or know exactly what it was, the confluence of events that led to that, but we are living in a more speculative technology market for sure.
Well, let's talk about that direct listing versus IPO thing a bit more. You're an investor in Asana, which went public earlier this week. I had some conversation with Frank Slootman at Snowflake, who had a more traditional IPO process. And there are people who are saying, Bill, you got a point about the traditional process needing some changes, but you're taking it too far. There are good things about the traditional IPO process. Direct listings and SPACs aren't for everybody. Do you really think direct listings and SPACs are for everybody now?
Well, you argued both sides of this argument yesterday, which was great.
On the other hand,
I actually think direct listings are the exact right model for everyone. And I would even say, the traditional IPO, we were talking about this on CNBC over a year ago. Ironically, in year to date, 2020, the total underpricing dollars on the traditional IPO is $24 billion. And it was in the 6 to 7 range the past 2 years, up from 3 the year before. So this thing has accelerated and gotten exponentially worse. The Snowflake IPO that you talked about was $4.5 billion. And it turns out that you just don't have to use a sheet of paper and a human guess to price something and decide who gets the shares. You can simply match supply and demand. And that's exactly what happened with Palantir and Asana this week. Everything went smoothly. It all went great. Most people don't even know this, but the way they opened Snowflake the next day is the exact same way a direct listing works. You just match supply and demand and use the systems that are built into the NYSE that have been there for years, which Stacy was talking about on air that day. And so it's way more elegant. We have a situation where the number of public companies today is half of what it was a while ago. And you ask, well, why is that? Well, the average IPO this year had to underprice by $200 million. So you have a $200 million tax to go public through the traditional IPO route, which is completely unnecessary. And one remnant or one response to that, I think, is the SPAC craze, because you've created this massive pricing umbrella arbitrage to get a company public, where the traditional route means someone gets to allocate $200 million to their buddies. Well, if someone gets to do that, the SPAC sponsors are saying, hey, Goldman, hey, Morgan, you don't get to allocate that money to your friends. I'm going to allocate it to mine. And that's exactly what's happening.
So,
You've seen
Bill,
one last point. If you look at the SPAC that Gerstner launched this week, he's attacking the IPO. He's not. That's exactly who he's going after.
Shepard Smith here. Thanks for watching CNBC on YouTube.